Have you ever wondered how one of the most powerful, wealthy investors in the entire world would advise you to invest your money, even if you're not a full-time stock picker?
Warren Buffett.
Two-fund portfolio.
It's a simple, no-brainer investment.
Warren Buffett's two-fund investment portfolio.
That's why you go to an index fund, and that's why you buy over a period of time.
Warren Buffett, whose net worth towers over $150 billion thanks to savvy individual stock choices, left a surprising parting note. Despite his legendary career at picking winning stocks such as American Express, Coca-Cola, and Apple, his final investment strategy for his family was refreshingly simple. A simple two-fund portfolio strategy. Warren Buffett, like I said, is worth around $150 billion, but he didn't gain his enormous wealth through index funds. He did it by a simple two-fund investment portfolio consisting of 90% stocks and 10% short-term government bonds. Today, we're diving in to see how a simple two-fund investment portfolio can greatly increase your wealth, even if you're not an investing genius like Warren Buffett, which I know I am not. I don't know if you're aware, but Warren Buffett's strengths come from analyzing patterns, such as people's buying habits and behavior, and being able to identify patterns and selecting the best individual stocks to comprise about 90% of his investment portfolio. One thing I want to dive into and kind of steer a little bit off course is you'll hear many stories of people saying, oh, I went to the moon with this stock. I bought this huge stock. I lucked out and got lucky and bought Nvidia like in 2019 and went to the moon and now I'm rich. But very seldomly, we hear people talk about their failures, mistakes, or blunders, right? And that's the thing that people can get the most value from, is the mistakes. Like, oh, I gambled and went all in on this, or I over leveraged on this particular asset class. The mistakes are what people can learn from. But most people are too embarrassed or don't want to share their investing mistakes, and they're afraid that they'll be ridiculed. But that's the stuff, that's the real learning potential that people gravitate towards, identify with, and can actually benefit from hearing. Not the, I got lucky on one particular stock and now I'm ultra wealthy, like the top 1% that actually happens to, whereas the other 99%, that never happens. In all honesty, one of my investments, sure, I netted, I think it was a 26% return last year. Oh, sounds great, right? I'm doing so well. The year before, it was 4% negative. Like it was down 4% for the entire year. Like I'm not boasting or bragging. I'll do great some years, right? But then other years, it'll be down. That's just the way the stock market is. Doesn't mean I don't know how to pick stocks and investments, but most people will brag and say, I got a 15-20% return. Oh, well, we just won't talk about the previous year. Well, and that's part of investing. So if anybody is promising you, oh, I can get you a guaranteed, investment return, secrets that the rich don't want you to know, just sign up for my $2,000 course. Right. I will never do that. I try to be honest and transparent about my investing journey. And now back to the meat of our video. Step 1, the power of simplicity. It might sound counterintuitive, but Warren Buffett's main advice is to not try to pick winners, identify the winning stock, right? Try to be the go-getter and say, oh, I can pick out what's going to be next year's winner, and it's going to be this and this. And it's like trying to predict next year's weather forecast. You'll probably not do it with any certainty. You're better off trying to capture or encapsulate the entire market in the two-fund portfolio comprised of 90% stocks. That way, you're not trying to handpick and select the winning stocks, because chances are you'll never do it. By capturing the overall market, there'll be some losers in there, but it'll have some winners as well. And you'll be capturing that along with the overall growth of the market. In case we haven't met, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I discuss personal finance, investing, and investment portfolios. I've been investing for a number of years now, and I have the academic background and experience to back up what I'm saying. If this sounds like something you'd be interested in, consider subscribing to my channel. Step 2, unpackaging the two-fund portfolio. Let's look at the details of what the two-fund portfolio actually entails.
A simple two-fund portfolio, endorsed by Warren Buffett for everyday investors, allocates 90% to a low-cost S&P 500 index fund, such as the Vanguard S&P 500 ETF or the SPDR S&P 500 ETF Trust, and 10% to short-term government bonds, like the Vanguard Short-Term Treasury ETF, offering strong diversification, low fees, and long-term growth potential. while it may lack customization. This hands-off strategy captures broad US market performance and adds bond stability to help reduce risk during market downturns.
Warren believes in the strength of American business over time and that more growth is anticipated and awaits. The S&P 500 grew from $66 in the 20th century to over $11,000. You want to be sure to grab a slice of that income growth for yourself.
Pick out a very broad index, and I would probably use the S&P 500.
Next, the 10% allocation in short-term government bonds. You might ask yourself, why invest in bonds at all? It's because bonds offer stability, a safety net for when times get turbulent in the stock market, which Warren Buffett believes in. Think of bonds being there like a trusty sidekick. Robin isn't there to steal the spotlight away from Batman, but to support him in times of turbulence. Here's a real-life example like I promised. I spoke to a couple, Mark and Linda. They didn't do anything flashy with their investment portfolio. They actually just stuck to a few basic index funds. Like they had 3 or 4 that they always went to and invested in, and their portfolio performed awesome. Like it was great. And they only relied on 3 or 4 everyday index funds, like ones you've heard of, proving that just a simple, straightforward approach can yield impressive results. Section 3, why stock picking isn't for everyone. Warren Buffett has a message that trying to pick stocks all the time, the winning stocks, is a tall order. He once made a choice on Dexter shoes and it ended up costing him $3.5 billion loss, reminding us that, well, not everybody can pick a winning stock all the time. And by the way, trading stocks, day trading, it's a lot of work that I don't want to do, and I'm sure you probably don't either. In fact, studies show that 90% of day traders and stock pickers cannot beat the market. They can't beat the S&P, no matter how good their returns are, they say. Kind of like a chef. You're better off following a simple, straightforward recipe with great taste rather than dazzle and impress the crowd with some overly extravagant dish that just doesn't work and creates a lot of effort and hassle.
Just give it to me straight. Nice, simple, not complex.
Section 4, the role of low fees and compounding. Index funds offer low operating costs, which is one of their key advantages. Actively managed funds from a bank or investment advisor could charge anywhere from 1% to 2%. So if you had a $100,000 investment, this would be $1,000 to $2,000 you're paying annually every year. Even if the market goes down and you lose money, you still get charged that $1,000 to $2,000 every year, regardless of how your investment portfolio performs. By contrast, index funds usually have an expense ratio of 0.1%. In fact, Vanguard's flagship index funds have an expense ratio of around 0.04%. An index fund that only charges 0.04% for an expense ratio would mean that for every $100,000 you invest, you're paying only $40 per year, as opposed to $1,000 or $2,000. $40 per year for an index fund is a lot better than $1,000 to $2,000 for a mutual fund through a bank, say.
I think that the people who buy those index funds on average will get better results than the people that buy funds that have higher costs attached to them.
Over time, those small savings can really add up due to the nature of compounding interest. Now, you might be wondering, if a 2-fund portfolio is good, shouldn't I be considering a 3-fund portfolio instead? Wouldn't that be even better? Well, this would set you up for diversification, which is a good thing, but most likely you'd start to dabble into international markets. The key difference here is the international exposure. For instance, a well-known option is Vanguard's Total Stock Market Index Fund, or the S&P 500 alternative, paired with Vanguard's Total International Stock Market Index Fund, plus a bond fund. This approach broadens your portfolio to include thousands of companies outside the United States, exposing you to growth in emerging and developed markets alike. So why does Warren Buffett prefer the simpler 2-fund portfolio allocation approach? Well, there's a few reasons. Number 1, accounting standards. The US is known for its rigorous accounting standards, which might not exist and be as transparent in other countries or overseas. You get a certain level of reliability and consistency from US companies. Number 2, global integration. Many of the companies listed on the US indexes are not just American, they're global. For example, Apple earns a significant portion of its revenue from outside the United States. So even if you're only investing in domestic funds, you're still capturing a slice of global growth. Number 3, historical performance. Over the past several decades, the US market has outperformed the global market as a whole. Now, of course, past performance isn't indicative or guarantee future performance, but it is an indicator, and that's where Warren Buffett tends to lead. Well, chances are the US will continue to outperform the global market as a whole. Another interesting point about these portfolios is how they can be tailored towards phases of your specific life. Financial author J.L. Collins, in his famous book, The Simple Path to Wealth, advises that during your wealth accumulation years, you can afford to be more aggressive, perhaps even holding 100% in a broad market index like Vanguard's Total Stock Market Index Fund. The idea here is while you're young, you have time on your side so you can outride most of the market fluctuations that you'll encounter because you have time to recover. Then later in life, as you shift towards the wealth preservation stage, because you're approaching retirement, you'll start to reallocate and adjust your portfolio and your asset classes. So maybe you'll shift from 90% stocks to 75% stocks and hold more bonds, because then your portfolio will be less volatile. One thing you might not know is bonds are not guaranteed to be risk adverse. They're just lower risk. Many people don't know that. They also don't know that the bond market is actually 3 times the size of the stock market. But everybody talks about stocks and, well, you don't get that much publicity about bonds. I don't know if it's because they're boring or whatever. Section 7, final thoughts and takeaways. So, is a 2-fund stock portfolio allocation for everyone? Most people say
Yes.
because of its simplicity. However, there are some hazards with it, right? You do have to have a certain amount of diversification, know some about the stocks you're picking, but its simplicity really calls to people because it's not overly complicated. While others might prefer the 3-fund portfolio allocation because, well, it incorporates more of the global economy and you can still understand it and manage it with relative ease. But one thing to always consider is your risk tolerance, the global economy, and your timeline horizon of your investments. One final story of mine is my friend Ryan. He actually tried stock trading, stock picking for, I think it was 3-4 months. And he read all the books, took some courses, and I think it was after a month or 2, he was just burnt out. Like he couldn't do it anymore. He's like, this is crazy. I'm not sleeping good. I'm waking up nights. I'm checking analytics. I'm looking at charts. It's driving me nuts, and it's a lot of work, and you really got to be on top of the market. And you're trying to compete or beat people that have done this for decades, stock traders, and that have all the latest technology insights, the Bloomberg terminals, all of that. You most likely will never do it. Like, I'm not even going to try. And the headaches and the worry and the stress, and I don't want any of that. I want a low maintenance, low worry, anxiety investment portfolio. So whether you prefer the 2-fund portfolio allocation or the 3-fund portfolio allocation, the key takeaways are to keep it simple, diversify, and low expense ratios. Remember, Warren Buffett, who grew his enormous fortune through stock picking, actually said the best investment for his family's financial future is just low-cost index funds. There's something to be said about that. A little bit of backstory on me. I got into this because I was in oil and gas in Calgary, and I got hit by the downturn, the economic impact from almost a decade ago when, oil just tanked. And I was in a really bad spot. I relied on my one job, right? Like most people do. And it hit me hard, right? Going through layoffs and having to apply for contract work and part-time work, anything you could get in oil and gas. And I made the promise to myself that I would never be in that position again, relying solely on one source of income. Because you lose your job, you're hooped, like you're in big trouble. And I have a feeling that a lot of other people were or are in the same boat. So that's why on this channel I talk about personal finance, investing, and alternative means to manage your money properly so you're not caught off guard when such an event happens. If this sounds like something you'd be interested in, consider subscribing to my channel. I talk about real, in-depth, actual things that I've done or I've learned from my experience that I want to share with my audience. Now, if you're anything like I am, I watch a decent amount of finance and investing videos on other channels, and some of them move pretty quickly. And do you ever feel like when you're watching some of these videos and they're hitting you with all this jargon, these terms, all these flashy, fancy editing techniques, and you watch this 10, 20-minute video and you walk away and you're like, what did I actually learn? And you realize you actually didn't learn anything. Yeah, it was very entertaining and top-notch editing, don't get me wrong, but they don't really teach you much. And that's not what I want my channel to be about. I can throw in all these flashy editing techniques and just, possibly blow your mind, but you won't learn anything. That's not the goal that I'm striving for, just so you know. So that's a wrap. If you enjoyed this video and you're curious about what asset allocation is and you feel like you can sit through another one, here's a video you should check out right here. And also, if you're curious about 10 financial lessons that you can learn from the hit TV series Breaking Bad, check out this next video here.